Steve created those 2023 charts we showed you as part of the year-end review for the New York Times. So great charts. We've borrowed them from you, Steve. But give us a sense of going forward. You had the ones that defined 2023. Let's talk about what it looks like from your point of view in 2024. Let's start with the first one you had, inflation and rates. Right now, there's a lot of higher rates. Inflation seems to be coming down just in the United States as well as around the world.
Inflation has definitely done better than any of us thought. The economy has remained stronger, even in the context of a low unemployment rate and inflation coming down. I think it's important to note, as Larry Summers has done repeatedly on your program, that for all of the celebration, we're not at 2% yet. Wage growth is still running at around 4%. If you assume 1 or even 1.5% productivity, it implies an underlying rate of inflation of around 3, which is what core inflation is roughly running at. So the question is, does it get to 2? I don't believe the Fed is going to raise interest rates again unless something really untoward happens. But I think it would be really hard for Powell to start cutting rates with inflation not yet even at its target. The market obviously has assumed substantial rate cuts this year. Most of the people I know and talk to, including my own colleagues, I think generally we feel that the idea of 6 rate cuts, 125 to 150 basis points of rate cuts this year, seems pretty unrealistic to us. And therefore, you have to raise the question, what's the implication of that for the market, which obviously looks very closely at what the Fed and where rates are in terms of an alternative investment place.
So how does it inform your decisions as someone who oversees investment of a lot of money about equities? Because earlier, a year or more ago, you were on this program saying you're not so excited about equities because the rates are high, they're going to go higher, and that's going to really cut into the value of equities, given the discount rate. At this point, do you feel better about equities, given the fact that you think probably it's not going to go a lot higher?
Well, first, you were nice enough not to get too in my face about last year, but I'm going to do a mea culpa and say I don't think almost anybody I know in the investing business expected what happened. Obviously, you had the Magnificent Seven, but even aside from that, the S&P and the markets performed much better in light of high. Those rates right now are kind of where they were a year ago, but the market is, depending on how you want to measure it, anywhere from 15 to 25 to 40% higher than it was. So that's kind of an odd development, frankly, relative to history. Anyway, looking ahead, I think we feel that rates are not going to go up anymore. You did have at the end of the year a nice surge in things like biotech stocks that have been hit hard by rates. So we're cautiously optimistic, or at least not scared, about the market this year because we don't see the Fed raising rates again. Corporate profits are projected to be up a little bit, not a huge amount. The S&P multiple is still high, but it all seems kind of manageable in the U.S.
What about growth in the U.S. for the moment? Because a year ago, many economists were predicting a recession. Didn't have it last year. Not clear at all we're going to have it even in 2024 at this point. What are you looking at for growth for the United States going forward?
I have no more wisdom than any economist does. I think the consensus is for a small amount of growth, something less than 1%. The problem with predicting recessions, it's a little bit like the old Roadrunner cartoon. You're running around, suddenly you look down and there's nothing below you. If you look back, I think you would find that more often than not, people did not say we were in a recession until we were well into the recession. And so there are signs of the economy starting to weaken a little bit. The jobs market is weakening a little bit. Retail sales are weakening on an inflation-adjusted basis a little bit. You do see signs of stresses and strains, savings rates, credit card usage, subprime, auto delinquencies, things like that. I'm not predicting a recession. I'm just saying that we're close enough to the edge that it could easily tip either way, in my opinion.
One of the things that you focused on, including in your charts for the New York Times, were on wages, and particularly what happened with labor unions, which was a big story in 2023. Right now, last time I checked, real wages are actually going up somewhat, slightly in the United States, as opposed to going down. That's, on the one hand, bad for margins for corporations. On the other hand, good for consumers because they have more money to spend. As you look into 2024 and beyond, what do you think is going to happen with wages?
Yeah, look, there's no question that part of why the economy was so strong in 2023 relative to what people expected was because there was more purchasing power. Inflation came down a lot, and wage growth went up a little bit. And secondly, you have this very large budget deficit, $2 trillion. So the government's doing its part. In terms of wages, I think you're going to see continuing upward pressure on wages. I don't see a wage price explosion. I do think that expectations have been managed well by the Fed's rate increases and other things, and so you don't see, as economists would say, an unanchoring of inflationary expectations. They seem to be under control. So I think you're going to continue to see wage growth in the 4.5%, maybe 5% range. And then, therefore, you're going to continue to see inflation maybe in the 3% range. And then the question will be, what does the Fed do about it? I believe the Fed's summary of economic projections would have inflation pretty close to 2 by the end of next year. I'm not 100% sure we're going to get there. And as I said, I don't see them raising rates. I just see them delaying rate cuts if we don't get there.
Steve, one of the things you focus on is immigration. You do it in the charts for the year end of 2023. You've written otherwise for the New York Times about immigration. Immigration is an issue, certainly politically. We have a lot of people coming across the border. We have northern cities, including run by Democratic mayors, really upset about it. At the same time, we need a certain number of workers coming in. Give us your views on where we're going with immigration in this country.
Well, I got into this, David, because I was looking at China, and China's population is projected to fall from 1.4 billion to 770 million by the end of the century because of their fertility rate and the fact that they have emigration. 300,000 Chinese a year leave and nobody comes because it's a monocultural society. We take in 1 million a year legally, and if you just want to maintain our population, given our fertility rate, you have to take in 4 million a year, or else our population will start to decline. So we need these people. We have a 3.7% unemployment rate. They're not going to take away American jobs, but it is the most divisive political issue. And frankly, President Biden didn't say open borders, but he conveyed a sense that we wanted people to come here back from the first day of his inauguration. And the result is you have 3 million people a year now crossing the southern border and going through our crazy convoluted system. And the Republicans, therefore, have no political incentive really to solve this problem. Biden owns it. The country, even including Democrats, are very unhappy with our immigration policy. And there could be a deal in Congress. I think they're going to announce something this week. But I'm not that optimistic it's going to get passed.
And finally, Steve, because you take a longer view as an investor, are we just going to in a period where investors have to have lower expectations? We had an extraordinary period of essentially, I will call it free money, and that benefited us in all sorts of ways, including investors, I would say. There's a lot of talk right now that we just have to lower our expectations about what returns and regular expected returns will be going forward. Do you share that view?
Sure, and I share it for the reason you said, but I also share it, and I don't have these numbers in my head, by the following point. If you look back at what the market did in a 5-year period or a 10-year period starting in each year, you will find that in years where the P/E ratio was as elevated as it is today, the market's performance in the ensuing 5 and 10 years was pretty modest. It was positive, but it was sort of low, mid-single digits is my recollection. And so a lot of this is where you start from, and we're starting from a very high level. And so, sure, I think our expectations are fairly muted. And you and I have had a conversation, I think, last time. We're doing a lot more in credit, because if you can make 10% in very senior, well-secured credit versus what we think the market's going to do, we are still shifting our dollars in that direction.